All right, today was quite the roller coaster ride, up and down, or I guess down first, and then up, and then back down by the end of the day. All pretty much coming for the same reasons that we had our drop on Friday. So, but despite the fact that it seems like it's just we're one tweet away from the market taking off or the market dropping, there are some patterns that are developing that are reflective of the type of psychological environment that we're in right now. So and in today's market outlook preview, I kind of break down and preview some of the patterns that I do a much deeper dive in the 30-minute version of the market outlook. But you'll get an idea of what I'm talking about in tonight's preview. And then I also break down some important intermarket relationships going on. So let's go ahead and get started. Today is Tuesday, October 14th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, click this link up here in the top right corner of your screen. That takes you toward today's Market Outlook blog post that you get for free on our website. All you have to do is subscribe. And this is actually the page that will show up when you click on that link. If you're already a member, just click on login down here. But if you aren't, click join free. It will pull up this page. If you click this link, it will take you straight to this page. And again, just subscribe for free. You can also subscribe at the top of our page. And a lot of times there's a little pop-up that will pop up there as well. Again, that gets you access. Just go to Market Outlook, go to your video archives, and you'll get access to all of our blog posts on this page every single day. These are all free and has the Market Outlook preview that you're watching right now hosted on that site too. All right, let's take a look at what happened today. So it was kind of a volatile seesaw kind of a day today. We had a little bit of a rotation into, out of these technology areas. You can see the S&P was down, the NASDAQ 100 was down, and it rotated into more value type stocks, in this case, small cap stocks, but also Homebuilders, which had been beaten up a little bit here. They benefited from, and that's a really strong short-term pattern right there, but they benefited from the drop in yields falling another 3 basis points down to 4.02% after these bear tags. The move lower here, the intermediate line's down. Of course, gold continues to be the big story. It's still moving up higher, but it was a clear rotation into areas of the market that are not typically the most bullish. So when I go here to October 14th and I pull up this chart, you can see staples, staples was the big winner today. Industrials and financials, materials, real estate were all utilities. They all outpaced discretionary, communication services, and healthcare. And we continue to get this rotation into these areas of the market. Utilities, healthcare, staples, materials. These are all sectors that are typically correlated and not very correlated with the markets, negatively correlated. In fact, if you look at healthcare, the last time, we're slightly positive. The last time we were slightly positive on healthcare, with healthcare breaking up above moving averages from below the 200-day, that preceded the beginning of the last correction or pullback that led into a correction. So this is not necessarily the relationship we want to see. We don't want to see healthcare, and we definitely don't want to see utilities, right? If you look at utilities and its relationship to the rest of the market, you can see it's really breaking up above the 200-day, and the long term is moving up higher. And again, that happened during the last correction. This is not a relationship we want to see as positive as it. Last time it was this positive was actually at the end, the washout of that correction, and we're getting it now with a negative correlation here. And you can see the correlation also got really weakly negative going into that February 21st day where that started the last intermediate decline. So very similar pattern that we've seen before. We're seeing again in this rotation. The breadth was better today. We did get enough stock. We did get more stocks above the 50-day moving average, but we're still right at the 50% mark, and we're below a falling moving average, which is not very bullish. The ratio of stocks above the 50 relative to the 200 is still at a bearish level, right? When it's very high like this and above a rising moving average, that tends to happen during declines. So that's not the most bullish. We want to get back below the moving average, and that will only happen when we get a large surge of stocks back above the 50, like getting back above the moving average there. So not quite there, but at least we're not breaking down. You can see the net new highs and lows jumped up. We avoided the Hindenburg omen again, just barely. We came that close to a second Hindenburg omen in 3 days. And, it's the cluster of Hindenburg omens that is the most ominous. And so we avoided it, and we'll see. It's the days like today where you get, where you get a strong move to the upside and a strong move to the downside. These are the kind of days, right? You get new lows on that move to the downside. You get new highs and that move back up, and those are the kind of days that lead to those Hindenburg omens. But we ended up, and as seesaw as it was, we ended up about as neutral as it can be, with a jump in volatility, which, and I break down in today's market outlook video. I break down what conditions we look for in the VIX that would suggest a jump in the VIX is coming, and not just a jump like we saw on Friday, but a jump, into the high 20s, low 30s, or beyond. So that's what we cover, as well as all the other intermarket relationships. Why is gold so important to the stock market right now? We break that down, and then we break down the sector moves, and then our trade idea of the day, taking advantage of the fact that earnings season is starting with the banking sector. So we took a trade on that in our market outlook. All right, well, that does it for our market outlook preview video. Click this link up here to be able to get access to our full version of our video. That takes you to our foundation subscription page. Again, it's just $29 a month. That's our most basic level of paid subscription at Market Scholars. You get access to all of our market outlook videos every day. We do one every day while I'm here, of course, when I'm not out of town. And we also do a trade. You get access to all the trades that we do every single day in the market outlook. We put those trades on in real time and manage the trades in real time in our market outlook live video. It's a live stream we do at 3:30 Eastern time every day. So you get access to that, and you get access to our market outlook live trade tracker, where we track the results of all these trades. So sign up for that. Again, just $29 a month. There's no commitment. You can cancel at any time. That works out to be about $1.40 per video. Thank you for watching tonight. Have a great rest of your Tuesday night. Remember to follow me on Twitter at DavidSettle42 for more content between the videos. You can also follow me on LinkedIn, Facebook as well, and like our stuff there. Like this video, comment on it, share it. Subscribe to our channel at Market Scholars. You can do that with this icon here or the subscribe button down there, so you're notified when these previews are posted. Remember, you also get the full video on Fridays for free if you're a basic subscriber, like I talked about earlier in the video. Have a great rest of your night again, everybody, and we'll see you all tomorrow.